Day trading has completely taken over the internet. And this makes perfect sense. Imagine a job where you can wake up from anywhere in the world, click a couple buttons on your laptop for an hour, and then drive off in a Lamborghini from little to no work. This sounds like the best possible job you could have. In reality though, you're getting sold a lie. Have you ever wondered why there's zero day trading billionaires, but countless hedge fund and long-term investment billionaires? Let me say that again. Zero day trading billionaires. Now, why is that exactly? Well, that's what I'm going to cover in today's video. The average day trader loses about 4.5% of their portfolio a year. That is just terrible, especially given how strong the markets have been in recent years. And that's not even the worst part. Studies tracking over 8 million traders have found that 97% of retail day traders lose money. It's not just that some of them lose money or that the ones that work hard make money and the rest don't. Almost all of them lose money. And it makes perfect sense why none of them last long enough to be a day trading billionaire. It's nice to be a dreamer and to not let the numbers define your goals, but there's just simply much better ways to make money in the markets, and a 3% win rate is not ever going to cut it. So today we're going to talk about why day trading is a trap, and why the apps, the influencers, and all the platforms all have a financial incentive to make sure you never figure that out. After being in this space long enough, I realized it's genuinely the most evil and pathetic scam I've ever seen get popular. Let's get into it. So let's talk about what day trading actually is. Day trading just means you're buying and selling stocks or crypto or options or futures within the same day. More often than not, you're using max leverage to do this. You're not investing for the long term, you're trying to catch small price swings and profit for them in hours and sometimes even minutes. The pitch sounds simple. Buy low in the morning, sell high before the market closes, and repeat. And oftentimes you'll see people blast their strategy all over social media. However, social media will only show you the success stories. It's always a guy in his 20s with the trading setup, the multiple monitors, and the gains screenshots. What it won't show you is the math behind it. They almost never show you the year-end broker statements or how their account performed percentage-wise, which is really all that matters at the end of the day. They'll even tell you to take money out of your day trading accounts to live off of and to buy fancy cars with, which kills your compounding gains long term. Any serious trader would never think about making a strategy, blasting it to the whole world, and then taking money out of the account as they make more gains. It's the complete opposite thing to do when it comes to making real money in the markets. If you simply bought a basic S&P 500 index fund and never touched it, you'd beat the overwhelming majority of active day traders. And even better, you don't have to wake up and instantly stress over the charts every day. Just leaving it there and letting it go will make you more money than the average day trader by a long shot. More often than not, day traders promote shorting strong markets like gold or the NASDAQ. I decided to give this part its own section because it really just is insane to ever think about doing this. Shorting the market means making money on the price of the asset going down. Here's something that most trading influencers will never explain clearly. Strong markets and strong companies have an upward bias over time. That's not an opinion or just a random guy saying that. It's the result of inflation, population growth, corporate earnings, and human innovation compounding over decades. The long-term trend of the market is always up. The only proof you need for this is just to take a look at the yearly chart for any major asset. Gold, silver, the S&P 500, NASDAQ, they all go up and to the right at a crazy rate. If that wasn't enough proof to you that shorting strong assets is stupid, just think about this scenario. When you buy a stock and hold it, your downside is capped at 100%. Worst case, it goes to zero. But your upside is theoretically unlimited as long as the company grows. That asymmetry works in your favor, and this is exactly how the markets play out. They just go up and up forever. When you short an asset, you flip that equation on its head. Your maximum gain is 100% if the stock goes to zero, but your losses are unlimited if the stock keeps climbing. You're fighting the natural direction of the market. You're betting against a long-term trend. And here's the thing, even when the market's correct, the long-term trend still wins. The S&P 500 was down 5.1% in Q1 2026, its worst quarter since 2022. Day traders who shorted that trend made a nice little 5.1% gain, but they're gonna get burned long term. The retail investors who held an index fund, they'll be fine because the long-term trend is still always up. Have you ever wondered why so many people keep day trading even when they're losing money? Well, it's because trading apps are not designed to help you build wealth. They're designed to keep you engaged, and they do it using the same psychological techniques as slot machines. They use bright colors, confetti when you make a trade, push notifications, sound effects. The interface rewards you just for that simple act of making a trade, regardless of whether or not that trade was a good idea to do in the first place. Regulators actually just fined Robinhood $7.5 million specifically for gamification violations for using these techniques to lure unexperienced traders into high-risk behavior. That's not a conspiracy theory. That's a regulatory fine that already happened. And here's why this works so well on our brains. Day trading delivers what's called intermittent reinforcement. This means that you win sometimes, not always, but just enough that your brain can't let it go. This is the same exact mechanism behind slot machines, sports betting, and social media scrolling. The occasional win triggers a dopamine rush that's powerful enough to make you ignore the more frequent and larger losses. Combine this with the fact that influencers blame you for losing money and not your unproven system, and you're stuck in a real dangerous loop. This is why people who lose $30,000 day trading just don't stop. They go bigger, trying to win it back. It's not necessarily that they're being stupid. They're being sold a lie, and they're experiencing a well-documented behavioral loop that platforms are deliberately engineering. A recent example of this was 21-year-old Alex Kearns. He got caught up in this exact loop on Robinhood. He saw a negative balance of $730,000 on his screen when he woke up. He believed he had catastrophically lost all his money and died by suicide recently after. The devastating truth behind this, though, he hadn't really lost anything. His options positions offset each other, and he was likely to be profitable in his trades. Robinhood's confusing interface failed to show that clearly, and his family sued and Robinhood settled. That's not a freak accident. That's what happens when platforms put engagement above clarity. Let's say you ignore everything I just said and decide to trade anyway. Here's who you're up against. It's not bad to be trading in the markets, and you can make money trading, but you have to know what field you're playing in. When you buy a stock or an asset on your phone, someone is selling it to you. That someone is often a hedge fund with PhD-level mathematicians, proprietary data fields, and algorithmic trading systems that execute thousands of trades per second based on statistical models you've never heard of. You, with your chart and your gut feeling, are playing poker against a table of professionals. You are not the shark, you're the fish. You stand no chance if you're just sitting in your bedroom staring at a chart with no math or statistic background. There is no get-rich-quick scheme. You need to put real effort into trading and getting a real education if you want a chance at being successful. A lot of influencers try to give you the education that you need to be successful in trading, but this is the exact lie I'm talking about. Influencers love to promote manual backtesting, the thing where you scroll back through a chart and say, I would have bought here, I would have sold here, and you write it down in your notebook. Well, that's completely worthless. It's plagued by confirmation bias because you're only seeing the patterns that confirm what you already believe. It's plagued by look-ahead bias because you know what happened the next day. Real statistical edge requires testing across millions of data points simultaneously in an automated, unbiased systems. Serious firms do this. Your pen and paper does not do this. It could take you a whole week to backtest 1,000 trades, but a computer can backtest millions of trades within minutes. Manual backtesting is the equivalent of writing math out on a piece of paper while calculators exist. It's 2026. We are way more advanced than this. If you're making decisions based on charts and instincts, you're not at an edge. You're liquidity, the money that flows from losing traders to the people running the math.
You want me to hold him?
Now, this isn't to say that you can't make money trading. It's quite the opposite, actually. Many people have become billionaires off of trading, but when you look at how they did it, the lesson is the opposite of what the influencers teach. Jim Simons, for example, built Renaissance Technologies and its flagship medallion fund into arguably the greatest investing machine ever built. It reportedly earned about 66% annually for 30 straight years. That's not a typo, that's real numbers. Jim Simons, however, is a mathematician. He is a highly educated genius who used math and numbers to his advantage. Now here's the catch with all this. Medallion Fund is only open to Renaissance employees. It runs on secret, proprietary mathematical models that took decades and teams of world-class scientists to develop. It uses enormous leverage, and it still has losing periods. This is not, I watched some YouTube videos and I'm going to scalp SPY options. This is proven mathematical systems that cost fortunes to develop, test, and it's impossible for the average person to get access to. Another great example is Richard Dennis. In the 1980s, he ran a famous experiment where he taught a group of ordinary people to trade using strict, mechanical rules-based systems. The quote-unquote turtle traders, as they became known, achieved remarkable results, but only because they followed a rigorous, emotion-free system to the letter. The turtle trader story proves that trading can be taught and learned, but it is imperative that you use systems that you follow. The lesson from both Jim Simons and the Turtle Traders isn't just that trading works, it's that the only version of trading that works requires removing human emotion entirely and replacing it with a repeatable, tested system built on real math. Most retail day traders do the exact opposite. They make decisions based on fear, greed, and FOMO.
Oh, what a handsome boy.
If you've been day trading and losing, here's the first thing I want you to hear. It's not a personal failure of discipline or willpower. The system is designed to take your money. You've been playing a game that's rigged in the house's favor. Recognizing that is step one. Step two is redirect that energy toward a passive index fund. The S&P 500, a total market ETF, something that lets the upward bias of the market work for you instead of against you. You don't need to pick stocks, you don't need charts, you need time and consistency. Even if you want to beat the gains of the normal market, using leverage still isn't out of the picture. But building financial models around making money in the markets going up is needed, and without it you're just playing a guessing game. From there, focus on getting more income, not trading gains. The most reliable way to build wealth in your 20s isn't turning $1,000 into $100,000 through lucky trades. It's increasing your earning power, investing a consistent percentage of what you make, and letting compound growth do the heavy lifting. You should almost never take money out of your trading account. It ruins the entire point of trading. Instead of staring at the charts all day, focus on your business or increasing your income outside of trading, and then let the money you make from that work for you. Ferner is actually moving right now to eliminate the $25,000 minimum capital requirement for pattern day traders. Critics are warning that this will just open the door for more inexperienced people to lose their money faster. Pay attention to what regulators are trying to protect you from. The math on long-term investing is simple and it works. The math on day trading is also simple, and it doesn't work for almost anybody. Here's the bottom line. Day trading is not a hustle. It's not a side income strategy. For 97% of people who try it, it's a money-losing machine dressed up in confetti and push notifications. The people who built real wealth didn't do it by timing the market. They did it by staying in the market. Your 3 takeaways. 1. The data is overwhelming. 97% of day traders lose money, and you're not the exception. 2. The platforms make money when you trade, whether or not you win or lose. Your losses are someone else's edge. 3. Passive investing beats active trading for almost everybody. Full stop. If this changed how you think about day trading, share it with someone who needs to hear it. I'll drop all the sources in the description. Thank you guys for watching. Comment any recommendations for videos you want to hear about in the future. Thank you guys. Have a good one.
We can take the children, but just the children. I made the case that...
Thank you. Thank you. Listen, okay? Listen. This is your chance. For you and this boy. I don't trust myself to keep you two safe. Not anymore. Please, I'm begging you. Please, stay here. Stay here, where it's safe. Where you two will have a chance.
No, no, no! Why are you doing this?
Because it's the only way. For both of you. But think about Alvy here. Please, Clem, just do as I'm asking. This one last time. You'll meet people. You'll make friends. People better than me. Good people. They don't have to look at you and feel ashamed at what they put you through. Please, Clem, please.
Okay. Okay, we'll stay.
Good.
We'll stay.
Good. This is the right decision. Okay? Right. When he's grown, you tell him about his mommy and his daddy and all the people who tried to keep him safe. You tell him, okay? He deserves to know. I got, oh, here, take this. When he's old enough, you make him wear it. It'll keep the sun out of his eyes. That's important. All right. Good. Keep an eye out for him. Please. Now, you take care of Alvin here. You live a good life, okay? Don't waste this, okay? Now, I'm gonna go before one of us changes their mind. Now, I'm away, and I might not look back. Not because I don't want to. I'm real glad to have met you, Clementine.